Good afternoon, guys. This is Mark, and we're back for the Monday meetings. We missed last Monday. I apologize. This is going to be relatively brief just because I think there's pain in this room, and we're all going to get headaches in about 15, 20 minutes. So bear with us for a little bit. But it's going to be very concise and to the point. The topic today is relative strength, relative weakness. Now, I've explained a lot of material on charts, game plans, how you go about your day, how you look at the different time frames. This is one of the most important topics we have to start looking at. Relative strength, relative weakness. It's what I sort of, haphazardly look at anyway, or sort of take for granted what I look at, and I don't really explain it a lot. How does something come on my radar, and I'm basically drawn to it versus something else just sort of is going with whatever the market is doing. I love stocks that we know that a lot of the stocks that we trade, the brokers, you can oil, the ags, a lot of these high beta, they usually go 1-for-1 with the market, or 1.5, whatever, depending on the beta. But the fact is, every once in a while, you find a stock or you find a position that is according to the market, it's relatively stronger or weaker than what the futures are. And for that, it's a good situation for us because we should be able to take advantage of it. And you have to look at it, because I had a trader next to me today was saying Fannie Mae looks like a buy. I'm like, okay, I agree with you on a 5-minute time frame. Okay, but what you didn't take into account today, and we can look at today as a thing, was that Fannie Mae, the futures did this at 12 o'clock, and look what Fannie Mae did. That left. No, this is my left.
You're right.
Okay. So the futures did, basically the futures, went up. The stock did not. And he was looking to buy it based on, a 1-year chart or a 3-day. In my opinion, it was a little extended based on what I saw over here. We all know what Fannie did. So I'm not going to go into it in that much detail. But I do want to make the point of, you really have to start breaking this stuff down so it starts to make sense, and you start to understand. A stock can be relatively strong in the AM versus the futures, or relatively weak, and that can change. It's our jobs to begin to figure out how to sort of determine that. And certain ways you can look at it is obviously either put the SPYs up or put the pound MS, which is for the magic charts. Put the futures, S&P futures, NASDAQ futures, depending on what you're trading. If the futures go up and your stock didn't, your strong stock didn't, two things you have to think about. One, should I be selling it and getting out of my position because it didn't rally as the futures rallied? Or two, does it just need more time, and is it going to hold its base? You got to start thinking about that, because really, relative strong stock should always go. A strong stock should always continue to go, probably farther and faster than what the market has given you. Vice versa, same thing. Stock is down, stock is very weak, stock goes down further, stock doesn't move. You have to decide, am I going to continue to be in this stock, or is it one of these things that, maybe the move is over, it needs to rest now for the next 2 hours, 3 hours, and I don't feel like sitting in it for that time period. These are things you got to think about as you're in it. Some of the best trades are made when you can see that your stock is stronger than the market, and the market is at a point where it's actually looking like it's down for the day, and it looks like it's going to rally. And when it rallies, what happens? Your stock should go farther and faster than the rest of the market. That is normally what happens. That is normally how relative strength or weakness sort of plays into what we do. A few stocks today that, I know LVS was something that was interesting this morning. This was going way beyond what the market was doing. And it's our job to figure this out early on, because we also know what the yearly chart looked like. The yearly chart, it was on my radar, and it was actually one of my plays of the day. The yearly chart looked great. It's been just slowly going down, and now it's finally, moving up, and it was moving up slowly. This was the day, it's starting to get some volume, and it could have another day. So you knew, okay, it was on the radar. It should have been on the radar. Now your job is to figure out, what is it really going to do according to the futures? Well, if you look at today, look what the stock did the first 5 minutes of the day. Futures popped, and then the futures have started slowly coming in, and you can see that. The stock, all it did was sort of base up at the top third of its trading range. To me, that's that's showing relative strength, good relative strength. And to me, knowing where it was at the chart, it's saying, you know what? You might be able to get another good trade in there. Now, you can either do one or two things. Wait for the market to turn, up, or just let it base a little bit and wait for the stock to do what it's going to do. Now, if you would have looked at this at 11:30, what is the market doing? Yeah, it had one little uptick, not much. But look what happened when the stock started coming down. The market started coming down. Again, I'm looking at the spiders. This stock started moving up. So to me, God forbid, the spiders started moving up and the market started moving up as a whole, this stock should go further and faster than everything else. And really, it sort of did it at 1 o'clock. And again, it's moved from 35 or something like that in a few days. So we know that, you know what, it's time that it could rest a little bit up here, and you use your bar charts to determine where to take the trade. But the key is to start focusing on using your energy and to find the right trades out there, the right stocks, the right positions to be in. These are important things to start realizing, because I feel like a lot of guys get caught up in stock goes up, they buy. The stock goes down, they sell it. But they're not looking at what the market's doing. Or it's just going one for one with the market. And to me, that takes away some of your edge. If it's just going up with the market and then down with the market, you have to know what these are doing pretty well. You got to know what the futures are doing pretty well and be in tune with that. And if you're not in tune with that, your edge is sort of taken away. And we're trying to add edge to your game, not take anything away. So we know we can trade a stock. Okay, futures going up, we buy a stock. Great, it's going to go up with the futures. But the key is, you want to buy a stock and you want to be in the stock that's going to be the strongest, or possibly weighing it in your favor, one of the strongest things, so you can take advantage of it. Give me a relative strong or weak stock today that you guys know about. Where's the mic? Yeah, just pass it up. Arnold. Give me a stock. Okay, we were playing. What stock were you playing today, Arnold?
Freddie Mac, Fannie Mae.
Okay. Well, Freddie.
Yeah, it showed a lot of relative weakness midday. The spiders came up around like 1:30, 2 o'clock, and retested the morning low. Freddie Mac couldn't even do that, so that's showing you relative weakness. And in comparison to Fannie Mae and other financials, it was just a lot weaker.
It was a lot weaker. It was the one to play. I know a lot of people were trying to buy it. This is the problem. This morning, Fannie Mae was screaming. And so all I was hearing in the room was, let's buy Freddie Mac. Okay, first concept, it makes sense. But when it starts to not do anything, and Fannie Mae is doing this, okay, we have a problem. We have a big problem, because you're chasing the laggard, not the leader. Okay? You have to go after the strongest stock. Fannie Mae was the strongest stock. It obviously has turned. It obviously showed its hand later in the day, and then it became relatively weak compared to the market. As the market started, rolling over, this actually rolled over quicker than some of the other ones. Took a little time, but it did it. And these are things to know when you're in these stocks. Freddie never rallied. I mean, it was up $1.50 and never rallied after that. After its first 5-minute, 10-minute pop, never did anything. So our job is to say, okay, we know relative strength, it doesn't have any. It's up $1.50, but it doesn't have any. So our job is to say, well, maybe there is a short out there. It had every opportunity in the world to rally. Fannie Mae rallied $3.50. Fannie Mae couldn't budge. To me, you have to start questioning, why am I trying to buy the laggard? When in reality, you should be waiting, not saying short, but if the market does turn down and Fannie Mae actually starts to get weak, what normally would happen to Freddie Mac?
Comes in hard.
It should come in hard. It should come in hard. Because a lot of you guys think the other way. You're like, oh, it came, Fannie Mae's up. Freddie should play catch up. There's times and places that should happen. Maybe not 4 days after a rally, 3.5 days of rallying, and the stock can't really get past this point. It's showing its cards. You want a stock to show its cards. It's giving us the edge we need. And you guys have to start looking at these relative strength, relative weakness parameters to help you out. Things that will help you out in this. Yes, we look at futures, but no relationships for stocks. If oil goes up, financials should come down a little bit. If oil goes up, what else should go up, possibly? Here, pass it to Matt.
Usually coal stocks tend to follow it.
Coal, if oil goes up, maybe solars, maybe ags, commodities. That's usually steel. Like this is how it normally works. It's just how these trade. So basically, everything else in the market goes down when oil goes up, except 3 industries: coal, steel, and solars, possibly. At least have that as some information for you to take advantage of. Okay, so we saw USOs. So if you're going to play oil, there's only one thing you look at. You can look at pound CL. You can look at oil, USOs. So if you're playing Apache, if you're playing Devon Energy, what are you looking at? Cleveland Cliff. You have to look at oil. You can't look at the spiders necessarily because they're not going to go with the market now at this point. They have changed. The attitude of the oils have changed in the last week. The reflection of the oil have changed. And you got to understand that. So, financials. We know financials go with futures. So we know that. What else? Give me other correlations. Any other correlations where we have that we should be aware of? I mean, there's always a bunch. If the Chinese market's up, then we know some of the Chinese solars and Chinese internets, and we understand that aspect. But anything day-to-day that you guys can think of that is good correlations that we should be looking at? Anything, Lee?
I think the oil one is the major one, as far as I can think.
Oil is the major one, in my opinion, too. I agree. I'm trying to think. I'm asking a question because right off the top of my head, I can't think of any.
Dollar to gold stocks.
Dollar to gold, yeah. True. Okay, that's one. And again, you got to use what is in your arsenal. I know I don't really play gold that much just because it's on the thing. I don't really look at the dollar too much. I know where it's at. So I'm just try to use these things. These should help with determining what is relative strong or weak. Now, if you're looking at something basically, if you're looking at something relatively weak and you think it's now coming to a place where it should rally, and the futures now start to come in, you should be going after the stock that is now turning weak, not that is all of a sudden chart-wise, it changes the inflection. These are important things you got to look at. Does that make sense to everybody? It's not just a one and done, because again, you look at a stock singularly, a chart will tell you so much information. But if you actually start putting it, superimpose the spiders or the futures on top of it, it's going to tell you a lot more. Is it just moving with the market? If it is, great. So you got to watch the spiders, watch the market, and watch the whatever futures you look at, and see, okay, this is as the futures start to hold on a 5-minute chart. I like what the spiders are showing me, or the pound MS, whatever it is. I'm going to look to buy it. I'm comfortable with it. But if all of a sudden there's that little whacked out movement, which happens every once in a while with stocks, it happens every day. It's just a matter of finding it every day, and finding that relative strength and relative weakness. That's where you get your conviction. That's where you get your A+ trade. God forbid all time frames look the same way. That's where you get your huge trade, and that's what we look at. It can look relatively weak on the 5-minute, but on the 15 and the and hourly, it's looking the same. And to me, that's a trade. Okay, you'll make 20 cents on the trade. That's not a $3 trade. That's how some of the guys in the other room really take advantage of these moves with conviction. It's not luck. It's because they understand the relative strength and weakness much better than a lot of people do. And if we can start getting in tune with that, you need futures involved with this. You need to look at the spiders as you play your stock. Okay, spiders rallied, your stock didn't. Okay, it needs two things that have to happen. Either it needs more time, or the futures start to come in. Your stock might be the one that comes in first. If that's the case, you know it's now relatively weak compared to the futures. Vice versa. The futures start coming in, your stock doesn't move. Your stock hovers near its mid-range. All of a sudden, the futures start rallying, your stock shoots off out of the thing. You just discovered that this stock has relative strength. To me, that's where your money should be going. Obviously, the key is to look at it and find it before it actually happens, but that is where the money should be going. And obviously, we back it up by all the different time frames we're looking at. That should help. Matt, pass it to Art for a second. Art, do you look at the different time frames?
Yeah.
Does it help?
5, yeah. That's the most important thing, though, I think, is the futures versus your stock.
Okay. Do you look at that a lot?
Yeah, I have the futures, and then I have my stock, and then
What time frames do you look at?
5 minutes on the futures,
Okay.
then hourly, and then 5, 15, and 2 minutes just for my executions for the.
And you go
stock.
out a few days on the 15, right?
Yeah, 3 days, and
3
then
days.
5 minutes from the day before and today. And then the 2 minute is just so I can just see exactly, because when the stock's ranging big, you can't tell the.
Now, if you see all them doesn't it help you sort of make your game plan a little better than just looking at a today chart of a 2-minute chart?
No, definitely, it gives you more confidence when you see everything just kind of setting up and looking right all together.
Right, and then God forbid you have all the things you need on the relative strength, the relative weakness to come into play. You're making money. You're making real money. Like today, what else did I play? That was. Yeah. Yeah, I mean, obviously, again, relative strength, you have to look at your yearly chart first to see what it's actually showing. It doesn't show it that well here, but that's okay. And then you just break it down accordingly, and then all of a sudden you should get some confidence. We know, if you just look at today's chart, you know it showed relative weakness early, and it never let up. And never let up. You think anybody knew American Express earnings were going to be bad? I don't know. To me, it looks like it. These are things you should be spotting. These are things that you have to start looking at and being aware of. It's not magical. It's just you got to do your homework. That's why I wonder when people come in at 9, how do you really know what things they're doing and how do you keep all the prices in check? You have to do your homework. Okay, these type of things you start seeing, because what happens is when it's hovering here or here, I bet you they're close to the same time frame. Yep. So 11:20, it's right here. It's now basing, popped its head, and then went below. This is where you have confidence, right here, that this stock should keep going down. Now the stock only went from 172 to 67 in basically, a half an hour. And look what the futures did. It's not magical. Yes, you're going to make your chops, okay? And if you didn't look at this and you didn't understand all the other stuff you're not going to take advantage of it the way you should. This is my point. You're going to be able to have some conviction on your trades because you know the stock is relatively weak. Finally, the futures are beginning to crack, and you know your stock should crack further than the other ones. And if all of a sudden these things start to work, you understand you can lay into it. And lay into it with authority and get some confidence that you know what? You're in the right trade. It begins to help you make that A-plus trade, A-minus trade. This, if I would have noticed it, I would have laid into this thing. I don't know the yearly chart yet, but I do know that, it was relatively weak, and I saw that before, and I do know that, with this pullback, it was, it was giving you a layup trade on the short side. So now, if it didn't do anything and the futures went down, what is that telling you, Ark?
I think it's probably just
Yeah, it might go back. It might go back to trade with the market. Okay, and that's our jobs. Our jobs is to figure out when the complexion of stocks change. Anything else that went, against the market today? Yeah, all the eggs. And we know what oil did. Look at that. If you're playing this and this, you're probably having a tough time. You got to probably put oil on there along with the market, with the spiders. Put USOs with the ags. You're in a little better position. It just matches a little better. And you should, but obviously, you know what the spiders are doing. You know what they're doing because you have to. You're going to be playing other stocks besides just the agricultures. Yeah, this was relatively a lot stronger than the entire market on versus futures. And you got to know that. And now you know the other indicators that we look at. If oil gets strong, especially in this type of market, the ags start to show some strength. The coals start to show some strength. The metals start to show strength. These are things we know. These are things that we follow. So if you're playing, Devon, and you're looking at the spiders, you might be having a hard time. You might be having a hard time. So these are things you got to start really looking at and understanding because they're going to really help you out. Sometimes understanding, what actually makes up some of these indexes and ETFs is actually pretty important. Versus just saying, taking it for granted. It's a financial index. Great. What financials? Well, it could have every financial in the world in there except the one you're in, and it doesn't matter. Or it can have, I didn't know BAC was one of the major ones on SKF. I like that. Because you know what? I was watching BAC a lot. And I'm going to actually back it up. I'm going to see what the SKFs have because I know I've been trading it a lot. So these are things we look at. Let's continue to look at it. Okay? Give me one other thing that was strong, weak. We know the ag. So every ag, was probably strong with it. Give me something else that was real. Yeah, steel. Look at that. Boom. Yeah. They showed strength, guys. And so some of them, and if they're showing strength, maybe that can determine what's going to happen with the oil. Again, we don't know necessarily which is normally the leading indicator. We're not smart enough to figure it out, and sometimes they change. You would say oil is the leading indicator in most cases. Today, honestly, I think oil played catch-up because these things were started rallying. That's what we're seeing today. So let's get these things intact. We have the spiders. What else did we play? Did we play RIM? What did RIM do? RIM didn't do anything. You see that? Google was relatively weak, right? It had earnings on Friday. Yeah. Boom. You saw it, didn't really rally, and look what happened. This thing fell. This thing crapped out. Then look what a rally happened. Look what happened. Google didn't even rally, barely rallied. And what happened? We pulled back in. Google put in harder than the futures. Relatively weak. We already saw it. It's our job to figure out how to execute it now. Very important, guys. Okay, good lesson. You need to have it on the radar. You need to have relative weakness and relative strength in your game plan. Understanding it. You need to have the spiders, the futures, oil. You need to know where they're at this point in time if you're playing stocks accordingly. It's the only way you're going to be able to take advantage of some of these stocks in some of these situations. Any questions? Questions? Comments? I know it was quick. Helpful? Do you need a little bit more on this? What's up, Claude?
How big of a move?
Very good.
How big of a move in pound MS would you want to see to really determine? How big of a move in pound MS would you want to see to really show relative strength or weakness? Because sometimes there's noise back and forth, and it's
Well, just like anything else, I like to see when it breaks through the noise. Okay? This, noise. This, not noise. That's all. This is noise. This all is noise. Again, when you start to see wide bodies, we know because the noise is starting to clear. If you start to see a lot of tails, we know it means there's a lot of noise. Okay, so maybe if you're looking at the futures, it's not doing anything. Yeah, it's jiggling around. You're trading a stock and it has lots of tails, you avoid the stock. most cases. Same thing. You use the same basic premise for everything. And you draw your charts accordingly. You draw your inflection points. Okay, where is the point that, you know what, if this breaks, it's going to have some speed up. You know what, if God forbid my chart looks the same way on this and it does the same speed up, then I'm in good shape. These are things you start to look at and start to see. Nothing changes, Raj. Nothing changes. You know what? I'm not giving you a definitive number that it has to move. Futures have to move 2 handles in order for you to get excited about it. No. Depending on where you're at, look at your 5 minutes, 15. Look at whatever time frame you're comfortable looking at, and with whatever time frame you trade at, and all of a sudden, you know, if they start breaking out of the range on the upside or downside, you'll see. You'll see it, because then they're doing a little bit more than nothing. Now, if all of a sudden it's moving in this nothing range, and your stock starts to head down and break the range, you also, that's telling you something. That's telling you that, you know what, there might be some relative weakness there. And God forbid the market starts to break down, what should your stock do? That already broke down 10 minutes before the market broke down. What should it do? It should go lower faster. Same vice versa. Same way the other way. Your stock broke out and the futures didn't break out. God forbid the futures break out. Your stock should fly a lot faster than the one that's just beginning to break out. Again, it's that special situation we're looking at. We're looking for situations where the relative strength, relative weakness, either one, we don't care which one. We just don't, you know, we want them to be 5 times what the market's given us. You know, they're exciting to us because they're going to set you up for your real type plays. God forbid they have volume and all these other things attached to it. You're going to make a lot of money with conviction. You're going to be in this trade. You're going to be in MasterCard for $6. You're going to be in for 4 of it. Why? Because you know. The market just started breaking down. You were able to sit in it. Now you should get rewarded for it. That's why. Okay? Anything else? I guess I don't want to keep you in here for too long. Okay, guys. Hopefully that helps. I know it's a little short, but again, it keeps your attention span. So, and I'm a little exhausted today. So hopefully everybody had a decent day, and let's get them tomorrow.